Hello everyone, this is Dan Gramza and welcome to Gramza Market Studies for Monday, May 6th. Now, you notice we're not starting with the chart tonight because there's something happening that I want you to be aware of. It's going to be a big deal. A lot of people are going to be talking about it. A lot of action I think is going to surround this, but I want you to know what's going on. And what it is, it's the launch of the micro E-mini futures contracts at the CME for stock indexes, and it's going to launch on May 6th. Well, here's something to keep in mind. May 6th is Monday, but May 6th trade date starts at 5 o'clock in the evening on Sunday, Chicago time, because that's Monday morning in Asia. So starting 5 o'clock Chicago time, Sunday night, these products will start to trade. And here's the big deal about them. They're 1/10 the size of the typical E-mini contract. That means with the micro E-minis, you have lower margins. It's going to require less cash to enter the market. If you're not familiar with margin, let's talk about that for a second. What margin means in the futures market, it is the amount of money that will be allocated from your account to secure a position, whether you're long or short. So if you buy a micro futures contract, that margin would be allocated to that position. If you sell a futures contract, that margin's allocated to that position. You do not have access to it, and once you close out that position, that margin would then go back to your account. We'll talk more about that in a minute. These micros, well, they're the 4 leading stock indices, the ones that you and I kind of talk about: S&P 500, NASDAQ 100, Russell 2000, and the Dow Jones Industrial Average. What we're also seeing with these markets, or these changes that's happening here at the CME group, is this. Let me just move this down to, there we go. The multipliers are changing. Now, what I'm going to talk to you about only applies to stock indexes for futures. When you have a stock index for futures, you take the level of the index that you see on your chart and you multiply that by this multiplier to give you the value of this contract. Well, for the E-mini, it's 50, but if you notice here for the micro, it's 5. And each one of these is 1/10 of the value for the full size or the E-mini contracts. So that is reduced, and we're going to see the impact of that right here. Let's go over to the right side of this chart. Here are the future levels, right, for these different markets. So your chart, by the way, is going to look the same. And the levels that you see, that's all the same. Nothing changes there. What's going to change is how your margin requirement for the trade and how the profits and losses are calculated. So here's that multiplier again. And if the E-mini at some point was trading at 27.86, you multiply it times 5, and you're controlling a notional value, is what they call it, but the value of the futures contract at that point was $13,930. Now, the amount of money you need to use to either buy or sell that contract is what you see over here under margin. It's $660. If you were doing the E-mini contract, it would be about $6,000. So now you're looking at a smaller capital requirement to now hold that position. Same thing holds true for these other markets as well. But let's move on. And what I want to point out here, these are the contract specs. You can also see this on the CME website. But here, these increments that these indexes trade in: 0.25 for the S&P, 0.25 for the NASDAQ, 0.1 for the Russell, 1 full point for the Dow. That stays the same. That's what's going on right now. But where you're going to see the difference is the value of that increment of change. Instead of $12.50, it's $1.25 for the S&P and 50 cents for all these other contracts. So let's just look at an example. If you and I were long the E-mini S&P 500 at 1373, the very next price or increment that it could trade down is 0.25, so it's 72.75. The loss of 1 tick would be $12.50. As it moves up, you notice that it moves up in 0.25 increments, and each time, if it moved up for us, that'd be $12.50. So to go from 73 even to 74 even That's $50 of value. Now, let's look at the same thing, only we're looking at the micro. So instead of $12.50, you notice you got $1.25. And as this market moves up, instead of $50 to go from 73 to 74, you're now looking at $5. Here's where it can come into play for us. Let's just look at a quick example. This is an example of a swing trade. This is a daily chart. It's on the E-mini S&P 500. One of the techniques I use, I call it a lead-up trade, but say this market breaks to the downside and you and I decide that if it rotates back up, we'd like to buy it at 28.25. And if it breaks down, if it fails, that if it trades below that low, we'll put a stop in there at 27.95. And as the market, in this case, happened to move up, we would now start moving. You see the sell stop is being moved up. It'll be moved up below these lows. And when the market trades below these previous lows, it would be stopped out. And it would have been stopped out here at 29 even. So we bought 28.25, sold, had our sell stop at 27.95. That's 30 points of risk. The profit in this case happened to be 75 points. The profit return on margin, that $660, was 62.5%. The profit on the risk was 250%. So let's take a look then at what we have here for the E-mini. If I was trading that, that means the risk for 30 points is $1,500. The profit was $37.50. The risk in the micro, $150. The profit, $375. So that means someone has a smaller capital requirement from $6,000 to say to $660, and the risk is less to their account. So this could be attractive, and it could be attractive not only in this swing trade, but also let's take it as a scaling into a trade. So you and I could buy 2 contracts here, and this market happens to cooperate, and it pulls back again. We could buy another 2 contracts, holding on to the original 2. And each time it allows us to buy 2 contracts. And here we'd be buying another 2 if the market would rotate higher. So that's 10 contracts. That equals 1 E-mini S&P contract. So it allows that trader with a much smaller capital requirement. In this case, we had 10 contracts. That would be a total margin of $6,600. But it allows us to maintain a position over a long period of time, because possibly the amount of risk that is the account is subject to could be acceptable to that trader. So if they have a $10,000 account, maybe this is a way for them now to hold that position. You know, they're not necessarily day trading, they're swing trading, and that's what we're looking at here. These are the types of trades that we contemplate in the videos that you and I look at. All right, we got to get going. Let's get over to the markets and see what's happening for Monday. We see positive movements in all these indices. I do look for follow through to the upside over here in the NASDAQ market. I'm looking for this market to get above 79 even. We had some really positive fundamentals coming out today. We don't have time to go over that, but let's move on and take a look at those currencies. The Japanese yen traded below its bearish level. The magnitude change here in that market, or I should say traded above, is $125 a contract, and I'm looking for an inside type day for that market. It's very interesting over here in the market I didn't expect to see a bounce in is the British pound, traded below its bearish level. Now the magnitude change there in that market is $375 a contract. I'm looking for an inside day on Monday. Let's move on over to interest rates, and there you can see, whoop, that's not interest rates. Let's get over here. There we go. In the 10-year notes, it started out so well. I was looking for it to break lower, and it did. And I thought, boy, this is right on target, but then it's rallied towards the end of the day. It could be profit taking. Next week, very important. Monday will tell us a lot about this market. Well, now let's talk about what's happening in the gold market. It did firm up. Silver traded above its bullish level. The magnitude change in that market is $1,100 a contract. Again, just to give you that reference. And what I'm looking for is an inside day in that market. Copper also traded above its bullish level, and the magnitude change here in that market is $1,500 a contract. Again, just to give you a reference. And I do look for an inside day slightly higher in that market. We have to be careful here. I am bullish on that market, but I'm not sure if fundamentals will support it. I feel the same way about crude oil, or I am bearish. This is a neutral setup. I don't look for movement to the upside, but basically a sideways type move. And soybeans continue their march to lower levels. The bullish level has been lowered to represent that kind of action. We are approaching levels that we could start seeing buyers coming into that market. And that concludes today's market studies. Thank you for being with me. I look forward to being with you again. And don't forget, 5 o'clock Chicago time, a new contract starts to trade on Sunday. Alrighty. Well, have a wonderful weekend. Look forward to being with you again. As always, take care.